Hello, my name is Mikko Kautto. This is Helsinki, Finland. We are now standing at the roof of our institute, on the 15th floor actually. The Centre for Pensions is kind of a secretariat for the Finnish employment pension system. We perform administrative tasks here. We help the pension companies in running the business, taking care of wage registers, pension registers, etc. And on top of the implementation supported tasks, we have also statistics, planning and research functions here. So we help the system to be financially and socially sustainable by providing the information base for the decision makers to keep this system performative. Actually, the Centre for Pensions is kind of a hybrid between private and public interests. We serve private pension companies, but we are regulated by a special law for the Centre for Pensions. That also perhaps is indicative of how we do things here in Finland. The private and public interests are combined, sometimes in not that easy ways, but in a functioning way. So we are rather pragmatic in things. Now we are in Finland, and Finland is supposed to be a Nordic welfare state. What do we mean by that? Something that is able to combine economic competitiveness, good economic performance with high social goals. Basically, two things stand apart when we think about a Nordic welfare regime, at least in the Finnish context. We are rather corporatist here, meaning that the social partners, the trade unions, the employers' organizations cooperate together, and they also cooperate with the government in a tripartite way. Also, we are a consensual society in the sense that the governments are always majority governments. We have no parties that are able to form a government by themselves, and even two parties aren't enough. That means that there are plenty of negotiations going on, consensus building and consensus geared decision-making structures that also could help us to understand why there's some stability in the schemes we have in place. What I will do in the next 15 minutes or so, I will try to outline what the Finnish pension system is, and also perhaps give you some insights on what are the good things we think that our system has, and also what are the challenges and problems we are facing here. Okay, are you ready? 15 minutes and I'll be your tour guide. Let's go. Finnish pension strategy contains two goals. First is to combat pensioner poverty, and the second is to guarantee a decent level of income continuation after you retire and you finish working. Because of these two dual goals, one can also say that we have ambitious targets and a costly pension system. Today, pension contributions amount to about 22% of the salary, so that's high in comparative standards, but they also guarantee a rather decent income for the pensioner. Also, you have to bring in mind that it's not only the old age pensions that are paid by this sum, but also disability pensions, widows and orphans pensions are included in the sum. Past history explains present solutions. Although we live in peaceful times, it hasn't always been like that. There were many cleavages, competing interests, and a real pension war in the Finnish pension history. First, in the 1930s, we tried individual accounts. Everybody was responsible for his or her pension by own saving. This didn't work out. In the 1950s, we turned into a flat rate scheme. All savings were socialized in a way and given to the Social Insurance Institute that was distributing them on a flat rate basis based on 65 years of age. The workers weren't really happy. They wanted an earnings-related system, and in the parliament this was passed, although the agrarian government wasn't proposing it. Then we had a national pension system and an earnings-related pension system. Two different kinds of principles competing against each other. Today, these competing interests have basically vanished because most of the people here have an earnings-related pension. They have worked and earned their own pension. The average new starting old age pension is about 1,800 euros. You can make the conversion. Anyway, it's about 60% of an average salary compared to those who are earners in the market. And also in terms of replacement rates, your pension is about 60% of your previous earnings. Now, the Finnish pension system and its key actors. First, the first pillar. We have a national pension system. It's a pension income tested selective benefit paid out by the Social Insurance Institute. A typical pay-as-you-go kind of a funding system, state-run, state legislated. Then we have an employment-related pension system, an earnings-related system. That's a hybrid between the first pillar and second pillar. Hybrid in the sense that it's legislated, it's a statutory system, it's mandatory. The finances are calculated as part of general government finances. On the other hand, it's very much private. It's run by private companies. It's financed really by employer contributions and employee contributions. It's a decentralized system where pension companies like the one we have here, Varma Pension Insurance Company, compete against each other on the market to get the customers from employers who by law have to choose one of the pension insurance companies. The earnings-related pension system is so high in coverage that there's not much room for occupational pension plans. Also, we don't have much supplementary or voluntary pensions. They do exist, but their role is limited. On the voluntary side, the employers can take a personal insurance for their employees if they want, or they can take a group pension insurance for a group they themselves see as a group. So a group here is, in loose terms, 2+ people. Then people can also take their personal private pension insurances if they want. These are often tax deductible, so they get a certain tax relief by doing so. Today, people can also put up a long-term savings account, which is also tax subsidized, intended to give incentives for people to save up a bit from their earnings and to top up the national and earnings-related pensions they are going to get. So, the players for these systems. For the statutory thing, we have the Social Insurance Institute, which is governed by the Parliament. So the Parliament and a group of parliamentarians, members of the Parliament, are sort of the board of the Social Insurance Institute. Whereas for the pension insurance companies, we have less than 10 pension insurance companies that are competing against each other in the markets, and we have a number of pension funds which are smaller players but do the same kind of an insurance function. These pension funds are governed by the social partners and the employers, but also the employees have a place in the boards. So the boards are made 50% of social partners and 50% of other interests. The pension insurance companies and the pension funds have a lobby for themselves, the Finnish Pension Alliance, which looks after the interests of these kinds of companies. On the other hand, in the financial industry, we also have the life insurance companies and the banking sector and other financial companies who compete against each other on the voluntary side. and they all together form the financial market in the Finnish financial services branch. Now, let's concentrate on the employment pension scheme, by far the most important scheme we have. I will take up 4 issues that could be of interest to you. First, the rules, the pension rules, the accrual. Second, financing. Third, the role of funds. And fourth, competition. So let's start with pension accrual. In 2005, we had the biggest pension reform in the history of employment pension scheme. The system was fully modernized. We changed firstly from a final salary principle to lifetime earnings. So pension accrual starts at the age of 18. Even 40 euros a month worth of work merits you pension accrual. So a typical work, part-time work, all kinds of odd jobs are also taken into account to your credit. You have 50 years of time to earn your pension. So from the age of 18 until 68, you can earn pension credits. Between 18 and 52, 1.5% a year. Between 53 and 62, 1.9% a year. And after the age of 63, if you continue working, you get a superannuation we call 4.5%. Of course, you get your pension at a little smaller time because you continue working. So we have also in this reform introduced a flexible retirement age. From 63 to 68, you can choose what to do, to continue or retire. So when you decide to retire, you will be given an earnings-related pension on a monthly basis. It's an annuity pension, so it's until you die, basically. Of course, the earnings-related pension system is quite meritocratic. It depends fully, or your pension depends fully on how much you work and at what income level. What happens to those who cannot work? Well, they get the national pension, or they can also get some substitutions from the employment system. For instance, if you study for a degree, you get a pension credit out of that. If you take care of children at home, you get a pension credit out of that. If you're unemployed, you also get a pension credit. So there are plenty of non-salaried periods during your career that are taken into account when your final pension is being calculated. But the most important thing is, of course, the earnings and your history of work. So the second issue, financing. Quite a lot of money is invested in the pension system. These contributions are gathered from different channels. The employers pay a big share of it, 17%. The employee contribution is about 5% of your salary. Then we have other sources from the state, from the municipalities, etc., that make up the whole pension purse, if you want. 80% of these contributions are being put to finance the current pensions, and 20% are put into funds, and they are invested. And the rates of return, or returns from the funds, up to a limit, also are used for paying out current pensions. So there's a cycle of financing going on, and depending on yearly returns, of course, the whole assets in the pension funds changes. Now, if we look closer at what the pension companies are doing, they are taking care of the pension payouts, they are taking in new insurances, but they are also running these huge funds. Each pension company has their own fund, and they are investing the funds in the financial markets everywhere, globally, trying to get a secure and good rate of return for their investments. So each pension company has their own investment strategy. They have their own portfolios, but on average you could say that 1/3 is invested in the stock markets. You have bonds that make up 1/3 or 40% of investments. You have different kinds of hedge funds, investments, alternative investments, but also investments into buildings or real estate market. Pension companies compete with their returns. If you're able to get a good return, you can also make a discount in the price of the insurance. So a good pension company may be able to get better customers because of its ability to give a reduced rate for the insurance the employer has to take. That's one of the main competing elements we have in the system. The competition part. As you probably understand, the competition is rather limited. We have a statutory legislated standard product that employers need to take. So it's a question of from which company do you take this product. The companies try to compete against each other with the investment returns, with the service they are able to provide, in being efficient in running their business, in keeping their management costs down, and in giving services to the employers, for instance, to their ability to keep their employees fit and in good working capacity. We're standing now in front of the Parliament, and we are talking about the role of the government. First, of course, in national pensions and employment pensions, all the laws are being decided here at the Parliament. The Ministry of Social Affairs and Health is the crucial ministry or department that is in charge of preparing pension legislation. Then we have the Financial Supervisory Authority that oversees the functioning and performance of the pension companies and running of their businesses. As I explained before, we have a corporatist system, which means that the social partners have a say on how employment pensions are being run in this country. This means that the employers' central confederation and the trade unions and the different trade union central organizations negotiate, try to look for a joint will concerning the future of pensions. They talk about pension accruals, they talk about investments, they talk about the functioning and non-functioning of the system, and try to reach compromises. Once they've done that, they have a contact to the government, to the ministry people, and then on a tripartite basis they decide how to continue. Of course, the flows of influence go both ways. So if the government or the ministry is not happy with the way things are with the employment pension system, they are going to put pressure towards the social partners. Yes, so the decision-making structure is as hybrid as it can be. We have the public interest, we have the private interest. We have the employers' and employees' opinions that are often in conflict. We have the influence from pension companies, we have the influence from social partners, and we have the ministry and we have the government. And all these different kinds of opinions are in different ways sorted out and put into some kind of a consensual reform. On what they can agree, that's how the future reform will look like. Key challenges? Financial sustainability, of course. For 50 years now, we've had pension contributions that have exceeded pension expenditure. So we've been running on surplus and been able to increase the funds. The funds are meant to serve as a buffer against short-term fluctuations, but also as a buffer for long-term in terms of the aging society. If you think of the financial issue at stake in the Finnish pension system, so much is depending on the risk sharing. Currently, and even in the situation of the stock market crash in 2008, it was the contributions that reacted. The pensioners didn't need to cut down on their pensions. In terms of social sustainability, one issue that's being raised by the 2005 reform is that we introduced an automatic stabilizer called the life expectancy coefficient. That's meant to play against the increasing life expectancy. So we will reduce the starting level of pensions if people live longer. So the pension capital is not touched, but the monthly pension is reduced in order to take into account the longer period of time we are paying it. In the future, we are going to have a less generous level of pension compared to the level of earnings in the society. So the 2005 reform was motivated not only by modernization of the system, but also by these financial concerns. A lot of the early exit routes were abandoned at that time, many age limits were postponed, and the levels of future pensions are not that good as they used to be in relative terms. Of course, in real terms, the levels of pensions are going to increase further. What this means in terms of future is that we have risks that are divided with different means. We need to have a higher contribution rate. We need to have better returns from our funds. We need to have less generous pensions, but we also need to work longer. So in 20 years, the target now is to increase our working careers by 2.5 years from the current state. So in a sense, all pension systems are highly risky. The Finnish employment pension system doesn't make an exception. What's perhaps unique in our system is that we are dividing the risks in different quarters of the society and keeping the more vulnerable, the pensioners, perhaps best protected. On the other hand, this puts, of course, more pressure to the employers and to the future generations who need to take care of the system's financial viability.